All right, now we are going to talk about consideration payable to a customer. Consideration payable to a customer. Now, this is something very common nowadays that the companies are selling the products to their customers, and there are arrangements in which the company is paying to their customer. Now, this may be something new for you, but quite common nowadays. Like you go to the superstore nowadays, big stores, big superstores, and you see the advertisement of the companies over there in the different ales. There are separate ales for different companies. There within the ales, there are advertisements uh, of the companies, different companies. The superstores, like for example, my company is, let's assume, ABC company, and we manufacture towels. Let's assume we manufacture towels, and there is a superstore XYZ. It's a superstore, and we sell towels to this XYZ superstore. Now it's a quite big store, that is why it is called a superstore. Now they have different ales within their store, and I want to occupy one ale, and I want to display all of my products over there, different sizes of towels. So I asked them that I will be needing a separate ale in which my products will be displayed. They said, okay, if you want a separate ale over there, you want to display your products over there, you need to pay us for that particular ale to sell your products, to advertise your products. Now, we are selling products to the XYZ company. They are our customers. But in order to display our products, in order to advertise our product in their store in a way which we want, they're asking us to pay an amount. Now, this, when we are paying, should be accounted for as a consideration payable to a customer. Now, what eventually it is, we are selling products to them. They are supposed to give us the money. And then we are having an arrangement in which we will be paying them the money as well for different purposes, for example, to advertise, to display. Eventually, whatever we will be paying to them should be a reduction in the revenue. Like obviously, let's assume they're supposed to pay us $1 lakh, and we are supposed to pay them $10,000 for the advertisement display. Now, what this will be the arrangement that eventually they will be paying us the 90,000. They will be deducting 10,000 from it. This is the amount that we owe to them regarding that advertisement and display. And eventually they are going to pay us the 90,000. So eventually whatever we are going to pay to them is a reduction in the revenue. So we see these arrangements very frequently nowadays in the form of vouchers, in the form of coupons, which the customers can utilize when they are paying for those things. So consideration payable to a customer includes cash amounts that a vendor pays or expects to pay to a customer, credits or other items such as coupons or vouchers that can be applied against amounts owed to the vendor. Even nowadays, when we give the targets to the customer, for example, if you're achieving this target, you're selling this much amount of units, you're achieving this much volume, then you will be paying you a certain amount. That is a consideration payable to a customer. Eventually, that is a reduction in the revenue. So consideration payable to a customer is accounted for as a deduction of the transaction price, unless the payment to a customer is in exchange for a distinguished service that a customer transfers to the vendor. Like unless the payment to the customer is in exchange for a distinguished service. Now that means, for example, I'm selling the towels, and to display the towels, we are paying them a certain amount of money. Now, the certain amount of money is eventually a reduction in the revenue which is coming from the towels. But what if I have another company? I have another company which manufactures, let's assume, the soaps, and we are selling the soap to them as well. Now, this soap is not displayed separately on their ales. They're just buying it, and there's no arrangement to pay them for the advertisement and display. Now, it cannot be adjusted against the revenue which is coming from which is the soaps. So that means it is actually a distinct good or service we are providing to them. So this is something very important. Other than that, for example, nowadays we have the companies which are selling many products, and they ask the superstores and the customers to display their wide range of products in a separate aisles. In that case, because they're having a collective revenue, all the products are being displayed over there, so there is no differentiation for distinct good or service because they are paying for the company as a whole rather than for designated products. Let's do an example, and then you will get the understanding that how this payment to a customer is a reduction in the revenue. This is an example, a very good example. We have two examples. A vendor that manufactures retail goods enter into a contract to sell goods to a customer, a large supermarket group, for a period of 1 year. The customer is required to purchase at least 20 million of goods, $20 million of goods during the year. Now, this is the amount of the turnover revenue we will be having from them, the company will be having from them. The contract requires the customer to make changes to the shelving and display cabinets at the stores from which the retail goods will be sold. On the date on which the contract is entered into, the vendor makes a non-refundable payment of 2 million to a customer to compensate for the related cost. Now, this is the consideration payable to a customer. We are paying them, the company is paying them 2 million for the display of their goods on the particular cabinets, particular aisles. The payment by the vendor to its customer does not result in it obtaining any distinct good or service. And as I told you that the company is selling the product as a whole. This is because although the shelving and display cabinets will be used by the customer to sell the retail goods, the vendor does not obtain any control of any rights to those shelves or the display cabinets. Now, the thing is that we are paying 2 million to them for 1 year to display the products. And they will be buying from us the goods worth $20 million. So that means we are actually paying them 2 million divided by 20, 10% of the total turnover, total revenue that we'll be having from them. So 2 million represents 10% of the amount they will be buying from us. So consequently, 2 million is accounted for as a 10% reduction in the transaction price when the vendor recognizes revenue. Now let's assume they have purchased the goods from us worth 4 million till now. Now what we will be doing, 4 million minus 10%, or you are going to multiply it by 90%. And this amount will be recognized as the revenue. That means every time when you will be recording the revenue, you're going to reduce it by 10% because eventually whatever you are paying to a customer, which is the consideration payable to a customer, is a reduction in the revenue. So we are paying 2 million to them, and they will be buying the goods worth 20 million from us. This represents 10%. So whenever we are going to record the revenue, now let's assume next time we're recording the revenue of 6 million, then again 6 million to 90%. Now, there's one more point over here. We have paid 2 million to them upfront. We have paid 2 million to them upfront in advance. Now, how we are going to record it? Like the credit entry is the cash. The credit entry is the cash. Cash is credited by 2 million. Now, what is the debit entry? It should be recorded as a right. It should be recorded as a right. Right to use the cabinets. Right to display the products on their superstore. So to achieve this, the 2 million is recorded as an asset and is amortized as these related sale to the retail goods are recorded. At first place, we are going to record this 2 million as a right, and eventually when we are realizing our right, we are going to de-recognize it and the revenue will be recognized accordingly. So this is the double entry. Debit goes to the right because you have paid 2 million upfront, and this is the right you have got from paying 2 million, and credit goes to the cash. Eventually, when you will be realizing your right, you will be amortizing this right. That means you're going to de-recognize it. Example, Golden Gate enters into a contract with a major chain of the retail stores. The customer commits to buy at least 20 million of products over the next 12 months. The terms of the contract require Golden Gate to make a payment of 1 million to compensate the customer for changes that it will need to make to its retail stores to accommodate the products. Now you see in this example, again, the customer commits to buy 20 million worth of goods for 1 year. And the vendor is paying the customer 1 million to make the arrangements in order to display those goods. By 31st December 20X1, Golden Gate has transferred products with the sales value of 4 million to the customer. Now, I told you that you're going to compare this 1 million, you have paid 1 million against the total amount, that is the 20 million. You will get the percentage. This is the percentage you will be paying to your customer. So this represents 5%. Now 5% is the payment that you are making to your customer in order to accommodate your products. Now, whenever you will be recognizing the revenue, you're going to deduct this 5% from it. So what you will be doing, you're going to record, for example, they have sold 4 million till now. Now 4 million multiplied by 95%, that means deducting 5%. So you're going to record 3.8 million of the revenue. So as I have told you that whatever we are paying to them, in this example, we are paying to them 1 million. So this 1 million is the cash we have paid to them. So credit cash by 1 million, and debit goes to the right. This is the asset you are going to record because this 1 million gives you the right to display your products in the particular cabinets to accommodate your products. So you're going to record it as 1 million. This is the right. Now, when you have sold the goods to them worth 4 million, you will be getting the cash of 4 million, debit cash, 4 million. Credit revenue by 3.8 million because you have deducted 5% from it. And now what is the difference? 0.2 million. This 0.2 million is the de-recognition of that right. The asset should be credited. This is the right that is going to be de-recognized because you have now availed that right of 0.2 million. So systematically, this right which you have recorded as 1 million is going to be de-recognized. That means amortized. So this debit entry represents the cash which you have received, 4 million. This credit entry, 3.8 million, represents the revenue, which is 4 million minus 5%. And this 0.2 million is the amortization of that right, which you have initially recorded, amortization of right. Now the remaining right is going to be 1 minus 0.2 is equal to 0.8. Now we have the fourth step, which is allocate the transaction price to different performance obligations. Now, in the step number 2, we have identified different performance obligations. Like we did the examples in the previous slides. For example, software is a separate performance obligation. Installation is a separate performance obligation. Updates, software update, and similarly the technical support. These were the 4 different performance obligation, separate performance obligation within the example number one within the previous slide. So these were the four separate performance obligation. This is the step number two. This was the step number two. In the step number three, we have determined the transaction price, which involves variable consideration, fixed consideration, and so on. Now, we are going to allocate the transaction price to different performance obligation because I told you that some of them will be met immediately, like some promises will be met immediately at point in time, and some will be met over the time. So the revenue should be only recorded for those which you have met, the promises which you have already met. And revenue should not be recorded for those promises which are yet to be met. So that means you're going to allocate the transaction price to different performance obligation because usually this is going to be a fixed price for a bundle. Now you need to split this amount to different performance obligation, allocate this transaction price to separate performance obligation. Now, the general principle is that you're going to do this according to the standalone selling prices. Standalone selling prices. Now, the principle of the standalone prices means what if you only sell the software? How much you sell for? How much you sell it? What if you only provide the installation service? What you charge for the installation service? What if you provide only the updates? So this is the way you're going to split. Now, obviously, when I'm talking about a bundle, this amount is actually a discounted amount. So that means this discount should be applied to all the performance obligations within the contract. If a customer is offered a discount for purchasing a bundle, usually this is the case, the discount should be allocated across all performance obligations within the contract in proportion to their stand-alone prices. That means on the pro rata basis. And this is a very common question within the exam. So we have to see it from the example. A vendor sells three products, product A, B, and C, to a customer for $100. Each product will be transferred to a customer at a different time. That is why we are concerned to split it. Product A is regularly sold separately for $50. Product B and C are not sold separately, and their estimated standalone selling prices are $25 and $75 respectively. So they're giving a discounted price of $100, but if you total all these three, $50 plus $25 plus $75, you get $150. So the accumulated amount of these separate products is $150, but we are selling it for $100. That means we are giving a discount of $50. Now this $50 discount should be applied to all the performance obligations within the contract. So that means we are going to take 50, divide by 150, multiply by 100. 25, divide by 150, multiply by 100. 75, divide by 150, multiply by 100. So that means when we apply the discount, the price after discount of product A will be 33. The price after discount of product B will be 17, and the product C will be $50. So you see we have applied the 50 to all three of the performance obligation. So this is something very important that you need to see, that we are doing this on the pro rata basis. Actually, you can write this formula in this way as well. 100 divide by 150 multiply by 50. Similarly, 100 divide by 150 into 25. I think this seems to be more logical to you. Similarly, 100 is actually the discounted price. 150 is the total price. This represents the discount. Multiply by the selling price. Now, when you multiply it by the selling price, you get the discounted price. So this makes more sense. Another example. Shred sells a machine and 1 year's free technical support for $100,000. The sale of the machine and the provision of the technical support have been identified as separate performance obligations. So these are the two separate performance obligations within the contract. Shred usually sells machine for 95,000, but it has not yet started selling technical support for this machine as a standalone product. They're just selling machine till now, and they're not providing the technical support as of now. Other support services offered by Shred attract a markup of 50%. Like usually when they're providing the other services, they usually charge a markup of 50%. It is expected that the technical support will cost Shred 20,000. Now, when we know the cost and we know the markup, we can easily compute, the selling price, isn't it? Like when we know the cost is 20,000, and we know in the markup the cost is 100%. So what we are going to do is 20,000 divide by 100, which this represents the cost, multiply by 150%, and then you're going to get the selling price. So when you're going to get the selling price, let me just describe it again. 20,000 is the cost. And remember one thing, that in the markup, the cost is 100%. In the margin, the sale is 100%. This is a very important concept, and probably you have, in fact, you have studied this in your earlier accounting papers, and let me revise it because you may encounter this in multiple parts of the F7 exam. So markup and margin. Just describing it. In the markup, the cost is 100%. In the margin, the sale is 100%. So you see that cost is $20,000, and this represents 100%. This is the cost. We need to compute the selling price, and for computing the selling price, we need to multiply it by 150. Now, what is 150? 150 is the selling price. 100 is the cost. When you add 50% markup, the selling price becomes 150%. So 20,000 divide by 100 and multiply by 150. So you get 30,000. So 30,000 is the price if they are selling the technical support separately. 30,000 is going to be the selling price if they are providing the technical support separately. So now we can compute the total price. 95,000 if they sell machine separately, 30,000 if they sell technical support separately. So 95 plus 30, you get 1,25,000. Now 1,25,000 is the total amount if they are charging for these two things separately, but they are giving it as a bundle, and the discounted price is 100,000. Now again, the same formula, you can simply use it. 100,000 divide by 1,25,000, and then you multiply it by 95,000. Similarly, 100,000 divide by 1,25,000, multiply by 30,000. This is how you are going to split it. Now we have the step number 5. Recognize the revenue when each of the performance obligation is satisfied. Now you're going to record the revenue when the performance obligation is satisfied. Now performance obligation means the promise. Performance obligation means the promise. And I told you earlier in the previous slides that when you are talking about meeting the promise may be met at point in time, and it is going to met over the time. Now, let's assume we are talking about the software. They give you the software license immediately. But regarding the software updates, they cannot provide you all the updates immediately because that is a systematic process. So when they provided you with the software, their performance obligation is satisfied at point in time. They gave you the software immediately. But regarding the technical support and the software updates, that will be provided over the time. So you have to remember this thing, that the revenue related to the promise, which is being met at point in time, can be recorded immediately. The promise which is going to be met over the time, similarly, accordingly, the revenue should be recorded over the time. Now, how you're going to analyze that the control has been transferred. So indicators that the control has passed include that the customer has a present obligation to pay. Like when a customer is supposed to pay us, when the amount is due on the customer, then this means we are done with our part and now they are supposed us to pay. When the physical possession of the asset is given to the customer, that means we have done our part and now they are supposed us to pay. When the legal title has been transferred to the customer, that means the control has been transferred. When the risk and rewards are transferred to the customer, that means the control has been transferred. When they have accepted the asset or the assets, and now they're taking the full responsibility of it, we are done with our part. This represents that the control has passed to the customer. Now, when the control has passed, that means the performance obligation has been satisfied. So that is something very, very important. These are the important points that you need to understand. So the benefits of an asset are the potential cash flows that can be obtained directly or indirectly, such as by using the asset to produce goods or providing services, using the asset to enhance the value of other assets, using the asset to settle liabilities. Now, this simply means that when they got the control, when they have the control of the asset, when the customer has the control of the asset, they can start using it. They can use it for the production, they can use it for the manufacturing, they can even secure it to the banks for getting the loans, they can hold the asset, they can use it wherever, whenever they want. So this represents that they can take the benefit from that asset, and that means control has been transferred to the customer. Now, this is an example how the services are provided over the time and how the revenue is recorded accordingly. This is an example regarding the over the time thing. On 1st January 20x1, even enters into a contract with the customer to provide monthly payroll services. Events charges 1,20,000 per year. Now, 120,000 per year means 10,000 for a month. 120,000 divided by there are 12 months in a year. So that means it is going to be $10,000 a month they are charging to them. What is the accounting treatment for the above in the financial statement for the year ended 30th June? Now, 30th June means 6 months. So 6 months, they have provided the obligation of 6 months. They have satisfied the obligation of 6 months. So accordingly, they can record the revenue of 60,000. Now, let's assume they received 1,20,000 upfront. That means they have received all the payment in advance. So the double entry is going to be debit. This is going to be my assumption, right? I'm assuming that if they have taken the all 120,000 in advance, because this can be a scenario in the exam. Mostly we see this type of question in the exam. So debit cash by 1,20,000. Credit revenue by 60,000. And credit deferred revenue, deferred income, deferred revenue, which is the liability of 60,000. In other cases, that if they have received only 60,000, if received only 60,000, in that case, the debit entry should be cash 60,000 and credit revenue by 60,000. If they have received all the payment upfront, then debit 120, credit revenue 60, and credit liability 60 because they've received the payment in advance and they are yet to provide the services pertaining to that. So the double entry is going to be debit cash, credit revenue, credit deferred income, deferred revenue, liability. And if they've received only 60,000, then debit cash 60,000, credit revenue by 60,000.